If you're trying to figure out the state of high-growth fintech, especially companies that are mixing, marketplace volume with actual credit risk, this deep dive is required listening. We are tearing apart the Q3 2025 earnings call for ACV Auctions, Inc.
And this was a quarter just defined by a stunning divergence. I mean, a real financial fracture. On one hand, you had management reporting really strong execution, gaining ground in a tough market, but that success, it just ran headfirst into this massive and I think largely unexpected financial shock.
That tension was severe, and the market's reaction was immediate and brutal. We're talking about a full capitulation in investor confidence. So our mission today is to cut through that noise. We're going to explain where the company succeeded and, more importantly, explain why the financial surprises just completely outweighed all that operational good news. Okay, let's unpack this with the hard numbers. Let's start with the results snapshot.
Right. So on the surface, the core business was tracking just fine. Top line revenue hit $200 million. That translates to about 16% year-over-year growth. So essentially, it hit what the street was expecting.
And when you look at efficiency, how they operated, I mean, things looked pretty encouraging there too, right?
Absolutely. The non-GAAP EPS was around 7 cents, which again met consensus. What was more encouraging, I think, was the adjusted EBITDA margin. That expanded by 280 basis points year over year, which brought them to 19 million in adjusted EBITDA. And that really signals improving efficiency in that core marketplace.
Okay, so if the operational numbers look that sound, where did the catastrophic surprise come from?
It was the massive divergence between that adjusted operating profit and the actual reported loss. The GAAP net loss, that's the real bottom line number, the one that accounts for everything, including credit provisions. It widened significantly to negative 24 million. Last year, that loss was negative 16 million.
Okay, let's put that in context for you. The non-GAAP numbers suggested they made about 11 million in, underlying profit. But when they applied the full accounting weight of their credit risk, they ended up losing 24 million. That is a $35 million swing. And it's mostly driven by these financial reserves.
Exactly. And the market fixated on that GAAP net loss widening. The next day, the signal was just unmistakable. The stock had a massive 37.5% drop. On 6 times the average daily volume, it sank to a new 52-week low.
Wow. That kind of price action isn't just selling, it's a fire sale. It sounds like the market was treating the credit part of ACV like a regional bank facing, insolvency. Let's start with the good news, though, because operationally they were a market share gaining machine.
They really were. They delivered record transactional volume. We're talking 218,000 units sold. That represents 10% year-over-year growth. And that is so crucial because management kept flagging how challenging the dealer wholesale market is right now. Gaining share in a shrinking or flat market, that's a sign of real strength.
And their penetration story, that just keeps accelerating. They hit a new milestone, 35% franchise rooftop penetration. That means they are getting their foot in the door at more and more of these established dealers.
And what's fascinating is how they're using their products to get around that market friction. Their ACV guarantee offering, which gives assurance on the vehicle's condition, is now their fastest growing channel. It jumped from just 11% of units sold in Q2 all the way to 18% in Q3.
And management said that the guarantee results in a 100% conversion rate, and it dramatically speeds up bidder engagement. I mean, this is the definition of product differentiation working. It's providing trust in a market that's historically been really opaque.
Plus, their logistics game is running clean. The transportation segment set revenue records, and the margin in that segment expanded by a robust 200 basis points year over year. So you have record volumes, strong logistics, rising penetration.
But if the marketplace engine is running so smoothly, where did this massive financial problem come from? We have to pivot now to the landmine that just dominated the call, ACV Capital.
This is where the whole story unravels. ACV Capital, their financing arm, saw its revenue grow 70% year over year, which is, by the way, accelerating growth for the 4th quarter in a row. But that growth was masking a spectacular surge in risk.
How catastrophic was it? I mean, what did that risk reset on the balance sheet actually look like?
Well, to simplify the numbers, the bad debt provision, that's the money they have to set aside for future loan losses, it surged 258% year to date. It hit $29.3 million. So they had to reserve over 3 times more money this year than last just to cover what they think their loan losses will be.
And that number doesn't even tell the full story, does it?
No, not at all, because it was aggravated by a specific high-profile customer bankruptcy, Tricor. That one event forced them to take an $18.7 million operating expense reserve. Now, that's a one-time thing, but the overall credit environment was so poor that their allowance for finance receivables increased about 690% compared to the end of 2024. That's an enormous tightening of the balance sheet.
Wow. So, given that shock, what did management do? Their response must have been swift. Were they forced to choose stability over growth?
Absolutely. Immediately, they announced tighter underwriting standards and a reduced outlook for Q4 capital revenue. They explicitly said they're trading that short-term revenue growth for de-risking the balance sheet. They're trying to get ahead of the problem, but it means a core growth engine is throttling way back, effective immediately.
And beyond the credit problems, we also saw some margin pressures hitting the core auction business itself, separate from lending.
We did. And this is where investors get, nervous about a buy market share strategy. Auction and assurance ARPU, that's average revenue per unit, it declined 3% sequentially, quarter over quarter.
So they intentionally lowered prices to gain that market share. Isn't that a classic red flag? Buying volume at the expense of profit, especially right before you reveal a major credit shock.
That is the investor fear, precisely. Management defended it, of course. They said it was because of targeted volume pricing and promotions, especially tied to that popular ACV guarantee to win over sellers. They promised that ARPU will increase sequentially in Q4, but that near-term drop, it clearly added to the negative sentiment.
And on the cost side, they flagged some higher expenses that are probably going to stay around for a bit.
Correct. Non-GAAP cost of revenue increased by about 300 basis points year over year. They said it was driven primarily by higher arbitration costs within a specific group of customers. Basically, as dealers feel the pressure, they're fighting harder over a vehicle's condition, which increases ACV's costs to sort it all out. And management expects those costs to stay high in Q4.
Okay, so we've got excellent market share gains, but they're undercut by rising credit risk, promotional pricing, and these sticky arbitration costs. Now, let's connect this to the bigger picture. We have to look at the strategic vision that's supposed to justify that high growth multiple, regardless of the credit hiccup.
And that management narrative is entirely focused on technology and data. ACV is leaning very heavily into AI. They see it as their long-term moat. They're investing in these AI-driven inspection and pricing tools like Project Viper and Virtual Lift 2.0.
AI inspection tools, that sounds great, but what does that actually do in the wholesale market that a human inspector can't? Is this real differentiation, or is it just a buzzword for the pitch deck?
It's differentiation by speed and consistency. The goal is to digitize and standardize vehicle defects and values instantly. You remove the human variability, and you accelerate the whole transaction. They said our pilots are getting very positive feedback, and they're targeting a commercial launch for these tools in 2026. It could fundamentally change how quickly a dealer can list a car and how much trust a buyer has in that remote transaction.
And then there's the Amazon Alliance. I mean, that sounds like a long-term catalyst that could completely change their risk profile away from just transactional volume.
It's potentially massive. ACV is the data and tech partner for Amazon's consumer trade-in experience for their new automotive marketplace. They're starting with Hyundai dealers. And this isn't just selling cars. This is a high-margin data and leads flywheel. They are monetizing their inspection tech, which really sets them apart from pure-play auction sites.
They also showed that their integrated data platform is a big cross-selling success story.
Very effective. They pointed out that dealers using their other data products like ClearCar or ACV Max, they increased their wholesale volume on the ACV marketplace by 30 to 40% after they signed on. So that proves the platform isn't just a separate tool, it's actively deepening their wallet share. They're also expanding their physical footprint. They launched their first greenfield remarketing center in Houston to grow commercial volume, which is still only around 6 or 7% of their total.
That is a compelling long-term story, but the immediate future is really governed by that guidance cut. What does Q4 look like post-credit shock?
Yeah, the Q4 outlook reflects a lot of caution, necessary caution. Revenue guidance is 180 to 184 million, so a step down from Q3. That's about 13 to 15% year-over-year growth. But crucially, Q4 adjusted EBITDA guidance is only $5 to $7 million. And that reflects the impact of, deteriorating dealer wholesale volumes. They expect those to decline mid-single digits and those higher arbitration costs we talked about.
And the full year picture, that really spells out the severity of the financial reset for the market.
It does. They updated the full year adjusted EBITDA guidance to 56 to 58 million. The prior street consensus was hovering around 68, 69 million. So that was nearly a $13 million cut to full-year earnings expectations. And that is the hard truth that drove the stock collapse.
And then looking into 2026, management is taking an extremely cautious approach to the macro environment, which also had to unnerve growth investors.
Precisely. Because of the uncertain backdrop, high interest rates making floor planning expensive, a lack of off-lease volume management said it was prudent to assume a flat dealer wholesale market through all of 2026.
A flat market for a high-growth tech name. That pushes off any kind of true tailwind for volumes until maybe 2027. That's a major signal that management is bracing for a sustained period of low volume, forcing them to rely almost entirely on market share gains and these other initiatives for growth.
The implication is crystal clear. Don't expect the macro environment to bail them out anytime soon.
So what does this all mean for you, the shareholder or the potential investor, given this deep fracture? The price action confirms that investors are heavily discounting execution risk and, critically, the credit quality of ACV capital. We saw that dramatic 37.5% collapse, taking the stock from 815 all the way down to 509.
And yet, despite that extreme selling, there's this striking divergence in sentiment. The average analyst price target still sits aggressively in the mid-teens, somewhere between $14 and $19. The consensus is still a buy or moderate buy. I mean, that implies potential triple-digit upside once the balance sheet stabilizes.
Right. This quarter just confirms that classic tension you see in these high-growth fintech models. Management is prioritizing long-term stability. They're de-risking by tightening lending and absorbing huge credit costs over optimizing for near-term profit. And the market is basically saying, show me the credit issues have plateaued before I'm going to reward that Amazon and AI vision with a higher multiple.
It's a classic investor waiting game for proof. And what's interesting is the insider signal that came after that initial rout. A large director bought about 80,600 shares, roughly $500,000 worth, on November 14th. That signals some real internal confidence that the selling was an overreaction and the stock is fundamentally mispriced.
That brings us to our final segment where we try to synthesize this extreme divergence, a massive sell-off, but with triple-digit analyst targets and insider buying into an actionable thought. This is not financial advice.
And we have to be explicit here. We are not advising you to buy or sell anything. We're simply analyzing the risk-reward narrative as it's been presented by the market data and the earnings call. It's the kind of pitch you might hear in an investment committee meeting.
So ACVA is down 71% over the last year and just suffered that capitulation-like 38% drop, hitting a 52-week low. The whole risk-reward proposition has been completely reset. The market has ignored the long-term optionality, the AI, the Amazon alliance, and is only focused on the immediate credit shock.
Right. And given that extreme divergence and the volatility from the collapse, the implied volatility in the options market is almost certainly inflated. When volatility spikes like this, it creates a unique short-term opportunity to monetize that perceived risk.
So our outrageous but plausible trade idea, reflecting that mindset, would be a long ACVA short volatility position. You would buy shares near the recent $5 low, capitalizing on the perception that the stock is just completely oversold.
And then simultaneously, you would sell short-term out-of-the-money put options, for example, the $4 strike. The premium you generate from selling those puts lets you effectively lower your cost basis on the shares you just bought. The thesis is that the bulk of the bad news, including that big Tricor reserve, is now fully priced in, meaning your downside below $5 is minimized. And by selling that volatility, you monetize the inevitable decay as the long-term story starts to stabilize the narrative. It's a calculated bet that the market has finally discounted the credit bomb.
This quarter was defined by that deep fracture between their operational strength record volume, successful product adoption, and the financial fragility that was revealed in ACV Capital. The credit division forced a major reset and a significant cut to the full-year guidance.
Exactly. The market has demanded cleaner credit execution and margin stabilization before it's willing to reward that long-term vision. Management is committed to tightening standards, and we've seen aggressive insider buying post-call, which suggests confidence.
So this raises an important question for you, the listener, as you assess this growth stock. Has the market fully bottomed on this name, given the comprehensive credit shock disclosure? Or is that 2026 assumption of a flat dealer wholesale market still too optimistic for a high-growth story that's expecting a major AI payoff?
That tension between proven execution and financial risk is the single factor that defines the current valuation. Thank you for joining us for this deep dive.